I'm Shay Russell for mining.com.au, and joining me today is the incredible Data Dan Petrie. Data Dan, it's great to have you back.
Thank you, Shay. I'm coming to you from Brookfield, just near a place called Gold Creek Road. Now, Gold Creek was, of course, for those of you interested in Brisbane history, it was one of the first major water sources. But of course, gold was panned for back in these parts, and there is some mining, some old mines still around these parts, surrounded by mansions.
Of course, houses and holes, the Australian way.
Absolutely.
Now, today's conversation for everybody listening is happening because I have an axe to grind and I'm taking no prisoners. And Dan, you are just the man that I want to talk to. So shortly after we recorded shortly after you and I finished our conversation last week, I shared an article with you that was extremely bearish about iron ore and said there was an economic winter coming Australia's way. Now, yes, for a lack of a better way of putting it, or even a lazy way of putting it, the air has come out of the balloon when it comes to the iron ore price. But you know what? There's a lot of strength in the Aussie dollar at the moment. That tells me that perhaps it's not as bad as that headline wants us to think. Dan, I know you've got thoughts and feelings on this.
Okay, so a couple of things, like we should bear in mind. So we have seen a moderation of some, particularly iron ore gets tied up with what's going on with the Chinese economy almost, that if there's any negative news out of China, it's almost inextricably, a terrible story for Australia. The volumes of iron ore are still very, very high coming out of Australia. So for context, when Port Hedland, for example, when it used to be, when that number exceeded 30 million tons of export per month, that was what was called extreme boom. That never to be seen again. Couldn't believe it. That was only a decade ago. Well, not even a decade ago. Now you have situations where you have the iron ore volumes at 44, 45, 46 million tons per month. That's a very, very big number. And it's not just China, but China's about 80% of it. That's the truth of it. And so a lot of it's also South Korea that in a lot of cases buys more iron ore than Japan. Now of course I am getting to all this, but yes, there is a lot of concern around the Chinese property market. Yes, iron ore is tied to that story. Yes, there is a story about volumes, and there's also a story about the price. But the price did drop stark below $100. But for people who are truly interested in this market, the Treasury boffins in Canberra will always estimate a price of around, in this market, around $70 to $80 per metric ton. For profitability reasons, iron ore in 2016-17, the profitability margin was you had to be extracting at $40 a ton to be profitable. When Fortescue was having some problems, they ramped up production, increased efficiency, and they're actually producing iron ore at $13 a metric ton. So the broader point is you have to sometimes look through what's happening now. Of course, yes, there is a property story in China, but the thing is, there's still an infrastructure story in China, and that is very, very strong. And of course, above all this, the GDP numbers, when you're growing at 5.5%, it's not the end of days necessarily. This is a $17 trillion economy. So unlike, probably the real worry for those in China is the same as Japan at the same point of their cycle, which was, they've got an aging population, but they'll just keep building. And so in Japan, you have bridges to places that are not even required. Fishing villages of 10 people have a most beautiful bridge, which was not needed. But by and large, is the story over. It's really a case of some measured commentary would probably be preferable to the more extreme versions of end of days and the new depression. And this is what happened in 1920 or the Great Depression or anything like that. Remember, Facebook and Yahoo had terrible stock prices during that time as well. I'm joking because they didn't exist, but that's my broader point.
So let's dial this back to some more measured commentary that actually makes this useful. So as you just pointed to that China is, let's stick on the China example. China is growing at a rate of 5%. Now those numbers are a little rubbery, but at the end of the day, that's still growth. That's not Western world economy growth where we're lucky to eke out 1% each year. So that iron ore is still being bought from us. It's still going to China, and they're still building things, aren't they?
Oh, absolutely. And so that pivot towards, like I was just saying before about the infrastructure play. Remember, China's the world's biggest manufacturer as well, and of course, iron ore has more than just one purpose. And so it's in terms of what it is actually the most rawest form of mining. Dig it up, ship it out, and that really is out of. It's not like, for example, you have to refine a lot of it. You can actually just extract it, and so therefore your ability to achieve, economies of scale and to do perform your tasks a lot cheaper. That's one of its key benefits. It's probably the downside for the sector more broadly is the fact that there's actually a limited number of buyers of the scale anywhere approaching the Chinese. And while I mentioned South Korea and Japan, if you look at them collectively together, they're still very small next to the People's Republic.
Well, you have mentioned South Korea and Japan. Let's talk some numbers. Let's put some actual
Mm.
numbers to this. What are the volumes of iron ore that we're currently exporting? And tell me, please, make all my Christmases come true early. Do you have any data around what port stockpiles are?
Well, there's a little bit around. So the Shanghai Sheffy, comes out weekly. Every Friday, you get a read on the volumes of what's on warrant, so what's being delivered to clients, and also what's the stockpile. So, of course, yes, iron ore is also they go to the kind of more rustic places on the South China Sea, not so much the international areas such as Shanghai, but in the Sheffy data is very interesting. Obviously, copper and those hot coils and all those rolls, so to speak. I'm probably gonna get that wrong saying hot coils. I keep thinking of my kitchen at home, but the things such as lead, zinc, aluminium are all again. They've had pretty good years, and and just to go off the rare bones of it. So, for example, copper is 260 odd million tons, I should say, of uh, they've got of copper on shore, and about half of that's you know ready to go to clients all throughout the mainland there. So that's those are pretty good numbers. That's the copper. Aluminium's the same. They've got some very very good numbers. So the tonnage rate is there. Like it is one of those cases of keep calm, carry on. And so a lot of I know it's a bit of a wartime theme we're embracing today, but if you were to look at this story, like the Chinese, for example, and even the Japanese, when times or there's economic uncertainty, the best lever government pulls is the one they go the bond market, or they raise debt, or they use their reserves and they build stuff. And if you were to draw a line again, this is coming out of a Second World War, but Japan and Germany, this is a tale of two. Both embarked on advanced manufacturing. They both embarked on building their countries again, but one was specifically about doing manufacturing and exporting it well, and that of course was Germany. Now China's trying to do a little bit of Japan, a little bit of Germany, but they haven't come out of a war, and for some reason I don't know why geopolitical tensions signal that that they're getting ready for one. I'm not saying they are, but every time they release a new aircraft carrier video, that suggests that they do. The point is that sometimes you have to kind of look through noise and see what the actuals are. And the actuals aren't that bad, but there is moderation, and really it is keep calm, carry on. If it fell off a cliff, we would all know about it. But that's when you do cry wolf effectively, not when, there's a retraction on any given month.
Yes, well, it does seem like there was a bit of hyperbole about it. Tell me, is that just because it's been a quiet news week?
Very quiet news week. September's quiet. It's all about the Fed. I love Jerome Powell, but that's really what happened. So like September is a pretty awful month. You're coming out of earnings season, particularly here in Australia. You also kind of there's also driving season. Remember, so it's summer in America at the moment. So what they tend to talk about is it's driving season. They've just come off a bunch of movies being released. They're getting ready for Thanksgiving in November. So the dynamic in America is kind of nothing really kind of happens, and then you have this October hits, and what does it mean for 2025 or the next year? And that's when the forward orders come in, and so that Q4 in any calendar month, tends to be kind of elevated for all these reasons that people are getting together, they're happier, it's the end of the year, and so that's there's a little bit of that. So
All right, Dan. So that is the week that was. What about the week that will be? What sort of data is coming out next week? Unless I
non-farm
find an
payroll,
article that'll derail what
non-farm
we're talking about.
payrolls,
Payrolls, non-farm payroll. Oh,
non-farm
are
payrolls.
we going to get another flash crash this time?
I hope not. And I say that from the perspective of, it's the problem with any type of retraction or correction. They're a very normal part of the cycle. You kind of have to look through them, but leverage does play such a big role, particularly for commentators who are often hopelessly compromised. Because they're looking at this, they're looking at their pension fund balance, or whatever vehicle they look at, and it's that fatalism is it's very much kind of we live in an age now of, like, it's almost Tinder for investors observe the Tinder phenomenon. Like they get their hopes up and they're dashed rather quickly, and when they wake up the next morning, they sometimes regret their decisions. And so that's kind of where we're at on the modern day. Everything happens quickly, crashes happen quickly, booms happen even quicker. So but look for the majors. So remember, first week of every month, you get the RBA cash rate comes out, you get Australian trade data comes out, you get the retail numbers, and that's across the board. You get the PMI reports, so what's manufacturing doing. So those are the big ones that are coming out. And so, of course, we will cover all those, Shay, when I write my column about keep calm and carry on. I'll also give a bit of an insight as to what's going on. I might even put it in the newsletter.
As much as what we've talked about here is extremely valuable, I can't help but think that one of my key highlights from this conversation is that this market is like Tinder but for investors. Honestly, like that's just that makes me feel warm and fuzzy on the inside. I feel like it's a very good description for it. All right, Dan, I have taken up far too much of your time, but I want to say thank you very much for today's conversation and letting me vent my frustrations publicly about that headline. For anybody watching, if you'd seen the internal whinging from me, you would know that I was quite passionate about this. Dan, I can't wait to speak with you next week, and may we keep calm when the non-farm payrolls come out.
I'm swiping left.